Now, our first guest has called herself one of the last bears standing, and she still sees some trouble ahead for the economy. We're joined now by Stephanie Pomboy, the president of the research group Macromavens. Stephanie, good to have you with us on Bloomberg.
Thank you so much.
Now, since we've last spoken, everyone has started to talk about the bond bubble, right? All of the money that has flowed, particularly among retail investors, into bond funds. But they only talk about a bond bubble when it comes to talking about U.S. government debt.
Right.
Why don't they talk about a bond or a potential bond bubble when it comes to corporate debt? Spreads have contracted, right?
Right. It's confounding to me because if you believe that Treasury yields are entering some kind of twilight zone and spreads on corporate bonds continue to narrow vis-a-vis Treasuries, then you'd think by extension corporate bonds would be getting into bubblicious territory. And also, substantially all of the flows that are going into bond funds are going into higher yielding, junk and corporate bonds, not into the safe treasuries that everyone is decrying as this monumental bubble. So I'm not here to say that, Treasury yields deserve to be where they are, but with the Fed potentially standing ready to monetize, I wouldn't get in front of that. And I think increasingly people are coming to that conclusion. What's interesting, though, is that they have yet to then connect the dots and say, well, if treasuries are going to enter this kind of vacuum and corporate yields are being dragged in tow, maybe we need to think about whether corporate yields really deserve to be at the levels they're currently trading at.
Now, when you look at, let's say, Treasury yields right now, the 10-year, we're around, 2.40, 2.4% for loaning your money to the government for 10 years. I mean, how does that sound to you in terms of whether it's a bubble or not? Is that just a sort of a risk-free trade, or is it really just full of risk?
Well, I know there's a vigorous argument around that topic, and I have for a long time been arguing the bull case for treasuries, primarily on my economic view, which has been, as you mentioned at the top, rather dour. And so I've been really fighting the conventional wisdom, arguing that rates were going to go lower and lower, and indeed they have. And I'm not arguing that the U.S. government deserves to be able to borrow at 2+% given our, woeful finances. But we have this serendipitous circumstance where, the rest of the world obviously is still willing to lend our government money, and the perceived safety of treasuries, whether it's correct or not, the perception of safety is still there. Plus, again, you have a Fed that stands ready to cap any, untoward rise in interest rates. So I never understood why you would aggressively bet against that. The Fed has unlimited power to cap interest rates if they so determine to do so. So I'm not as interested in discussing whether treasuries are a bubble or not, because I think the point is sort of moot. The Fed's going to make sure that we never find out.
All right. So if the Fed's going to make sure that we never find out whether we're in a bubble, particularly for U.S. treasuries, do you think that U.S. Treasury yields are going to continue their descent?
I've done a overlay of JGBs with the U.S. Treasury, and I basically tried
Japanese government bonds.
Sorry.
That's
yes,
all right. Japanese government bonds over U.S. Treasuries.
And basically what I did was I pinpointed the moment when deflationary dynamics first took hold in Japan, which I am calling basically when the velocity of money started to decelerate. So they were, pumping money and it wasn't going anywhere, which is exactly what's happening in the U.S. today. That dynamic didn't really happen in Japan until 3 years after the bubble bust. So it wasn't until the first quarter of '93 that velocity of money in Japan actually started to slow. We're already there. So if you overlay their JGBs for the moment when velocity slowed versus U.S. Treasuries today, we're barely getting started. And it does suggest that, we could see rates emulate what has happened in Japan. I'm not a strong proponent of that view. I mean, I guess my feeling is I don't need to be a hero on the next 25 basis points. You know, we're already so low. But I think the real surprise will be that rates stay at these levels for much, much longer than anyone's currently imagining possible.
Okay. All right. Stephanie Pomboy, we talked a little bit about the Federal Reserve and their attempts perhaps to use quantitative easing part 2. And we were just talking during the break about how strangely the attention has shifted on the terms of the Federal Reserve's balance sheet. Explain a little bit about that, because people were very worried about whether the Federal Reserve was going to be able to shrink their balance sheet quickly enough. And now the talk is maybe they're going to have to expand their balance sheet and start buying all those treasuries. How did we get here?
Right. I take this as an enormous vindication of the bear argument that I've been putting forth. I mean, at the beginning of the year, the concern was we're going to have some Weimar Republic-style inflation because the Fed can't possibly rein its balance sheet in fast enough to prevent inflation from taking root. And here we are, you know, a handful of months later, and people are salivating at the prospect that the Fed might have to re-expand its balance sheet. And so I think what it gets down to, and this kind of maybe segues into the earnings announcements coming up, is that there's been this, I call it an illusion of recovery, but clearly the data that have suggested, you know, the consumers come back and spendings come back have been sort of benefited from 3 factors. One is the very easy year-on-year comparisons to the post-crisis bunker mentality that consumers evinced in the early part of 2009.
Where almost all spending stopped, whether it was consumer or corporate. Everything just stopped.
Exactly. And so we had really easy comparisons up until basically till October. This month is when things start to get a little bit more difficult, and then the challenge rises in the months after that. The second sort of tailwind for the economic data was the fiscal stimulus. We had massive government transfer payments. We were extending, you know, unemployment benefits constantly, plus the stimulus, the original stimulus package. So all of that helped replace wage income. You were getting income from the government instead of your former employer. And then the third thing I call squatter saving, which is this phenomenon where delinquent homeowners were living rent-free, basically, because the bank couldn't possibly get around to processing all the foreclosures fast enough. So you have people living rent-free for 12 or 18 months, which is a huge windfall. So those 3 forces together, I think, conspired to make the spending data look better than they really were, or certainly they certainly weren't sustainable factors, and I think we're starting to see that happen, and we will as we get through these year-on-year comparisons. So I think that had a lot to do with this perception that the Fed was too easy at the early part of the year, and why it suddenly changed, and people are now starting to say, maybe not only weren't they too easy, maybe they need to be a little bit more aggressive. And I think that will just further extend as those year-on-year comparisons start getting more challenging and the stimulus fades and banks start actually processing those foreclosures, which they're starting to do in record number now.
Well, it also highlights the notion that there's almost a schizophrenia in the market. On the one hand, if you're looking for quantitative easing to be a windfall to the stock market, quantitative easing is really nothing more than an admission that the economy isn't doing very well.
Right.
So it's nothing to really cheer about from an economic point of view, is it?
It's not, but, you know, we always view extra money as solving all the problems. We'll just throw some more money at this. And even though the mechanism is clearly broken for the Fed, which is no one wants to borrow, so or the people who want to borrow aren't the ones the banks are willing to lend to. So we have a broken credit mechanism there. So I don't know why expanding the balance sheet another $1 trillion is going to change anything if we're just not getting the engine to work.
So it's almost shoveling the wrong kind of energy source into the boiler. If you take a look at corporate earnings, and as I said, Alcoa coming out tomorrow, we've got PepsiCo coming out tomorrow. You talked about those early comparisons, how they were going to be good. What happens now if those earnings aren't good? Do companies take all the cash that's on their balance sheet and start shoveling that back to investors to keep them happy?
I think that's the next thing. The Fed's trying to shovel money into the economy to no avail. I think companies will probably have much better success in lavishing some of their cash riches on shareholders in the form of dividends. I mean, I've been just struck at the divergence between the massive ramp up in cash and dividends, which have actually tailed down. And it's very unusual. In fact, it's unprecedented for as long as I could see to have a divergence of that magnitude. And the only reason I can think of is that companies know they don't need to spend it now. Shareholders are reasonably happy because they keep hoping that next quarter will get top-line growth. So I think that you might get into a situation where companies start to come out and confess that maybe top-line isn't as robust as they thought, but they say, don't worry about that. Here's some money. We'll throw some dividends at you to make you feel a little bit better about the situation. And
is it possible that one of the reasons they're keeping all this cash on the balance sheet is they've gone through this big liquidity crisis, and so they're just worried?
I think it's a combination of things. That certainly is a logical one, and they have very shrewdly reduced their dependence on short-term financing as part of that. But it's also, I think, it's waiting to be used as bribes for shareholder loyalty.
You're going to keep us up to date. I want to thank you very much, Stephanie Pomboy, coming to us from Macromavens.